overall the markets look fairly mixed today, and we want to draw your attention to PepsiCo, which pretty much year to date is down around 3%. It's currently trading towards its 52-week lows, and you could argue right now does offer a fairly attractive yield at around 3.3%. So is it undervalued? Should we consider it in our own portfolio? Let's take a deep dive. The first thing that we have to draw your attention to is the earnings from just last month, and unfortunately they trimmed their revenue outlook, which isn't a good sign. They believe the consumer environment is weakening, something we have heard from others in the industry like Coca-Cola and KDP. And they do reference here the North American snacking in particular. Now we do note from some of the highlights that they did beat on the EPS, however their revenue did come in under what Wall Street wanted, and unfortunately they have had to lower their full year outlook for their top line. So in terms of the EPS, we did already mention a beat, although fairly marginal, 231 versus the 229 anticipated, and the revenue, although you could argue was a marginal miss, it was a miss nonetheless. In terms of their net income, their bottom line for the quarter, we saw that around 213 per share, which unfortunately from the same quarter last year has come in lower, as we can see 2023 coming in at 224. And what management focused on in the call was that there was a weak demand in North America, and they believe this is affecting their total volume, which we will come to show you now has started to decrease. They say shoppers have become a lot more cautious, not only snacking less, but they are buying less purchases at their convenience stores. And as we have said, this is pretty much mirrored a lot of what we're hearing from the industry competitors. Now let's just take a look at this graph, which ultimately tells us two things. Firstly, over the last few years, what PepsiCo have been doing is increasing their prices on a quarter by quarter basis, but at the same time, which isn't great, the red line is showing us their volume, and in essence what is going on here is that especially since 2022, they are starting to sell less and less of their products. Now, one way they are counteracting that for their shareholders is by increasing the prices, but what we're seeing here isn't really a long-term solution. They've noticed that consumers are buying less over time, but what they are doing is they're increasing the prices. So they continue to increase the prices, consumers continue to buy less, and then we end up with an unfortunate situation where they could continue to miss on their top line revenue. Something definitely we would say to be aware of, as we can in fact see since September 2022, their volume, the amount people have been buying of their products has been decreasing, and during that same period we do notice some very large increases to their overall products. In terms of their earnings per share, they do still expect over the next 4 quarters to be increases on a year-on-year basis, and over the last 4 they have also outperformed what management expected, so 100% track record, with growth expected to the EPS over the next full year, lowering the forward P down to 19, right now sits around 20, which is lower than the S&P's 25. Now, in terms of looking at some information about this company and their metrics, first things first, Dividend does look to be very safe, 93 score. We'll cover these two models which show severe undervaluation, and they did increase their dividend 7.1% in February this year. Now, dividend safety was reaffirmed just 2 weeks ago, ultimately meaning for PepsiCo a dividend cut is highly unlikely. Now, these are key metrics from the last recession, 07-09. They increased the dividend, they had above average growth, negative 0.5%, S&P was negative 12, and they also massively outperformed the S&P, negative 35, S&P itself, negative 55. Now, they've also been increasing those dividends at a very favourable rate, in fact 11% year on year on average over the last 20 years, and they are also an official dividend king with more than 50 years of consecutively increasing those dividends. Now, the first model we're looking at is the valuation based on the forward PE, and when we zoom into over the last year, with the blue tunnel essentially showing us the expected fair price, we can see for the last 12 months, this company has been even lower than the bottom end. In fact, the gap is increasing, which gives us a severe undervaluation signal. But remember, we're not looking at these models in isolation. We're going to run it through our own valuation later on and get to our conclusion. Then we move on to dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year average. 3.3, this is one of the highest yields they've offered over the last 5 years. 2.84 average, so that is one undervaluation. Another one, forward PE just above 19, is above the 24 historical average, and we can see again one of the lowest it has been over the last 5. Then we get to the sector comparison, where we do note, in fact, consumer staples do sit lower, although marginally at 17.8. Now when we get into the free cash flow payout, as always, free cash flow over the earnings data, which is susceptible to manipulation by management through accounting, below 70 is what we want for consumer staples. This is one worry that we continue to flag with this company. Their payout is very high, triple digits in 2022, triple digits over the last 12 months, indicating management are paying out more in dividends than they're generating in free cash flow. Definitely something we want to flag, although we would say over the next 12 months, this is anticipated to come down to around 70%. Then we move to the free cash flow per share, where we want consistent increases over the longer term. We get the opposite, we get inconsistent increases, and some years, or in fact many years, where it just continues to fall. So definitely be aware of this, maybe add a larger margin of safety that we will come to later in the episode, that over the next 12 months, it is anticipated to have a nice increase to 776. Then we get to sales growth, where we want 3 to 7%, 3 to 4 just at a bare minimum to keep up in line with inflation. Now, it has been very inconsistent over the last 10 years. In fact, over the last 12 months at 0%, we don't believe we are going to see, in fact, around that inflation rate this year. So again, just a heads up. And from a numerical basis, we see around 40% growth over the last 10. We then move on to shares outstanding, where we want to see companies return excess cash, lots of share buybacks. We do see very minimal over the last 10-year period. Some years they do, some years they don't. In fact, just over the last 4 years, we do see relatively minimal movement, but it is a nice added bonus. Clearly though, management, this isn't part of their capital allocation for the time being. ROIC, 12% or more for consumer staples, looking very strong. In fact, very high teens, low 20s year on year, 20% on a trailing 12-month basis, so this is a good sign of consistency for what we deem to be a very important metric. Operating margin, while we see no efficiencies, we do see it very much straddling around the 16% minimum that we want to see on a year-on-year basis. Same to be said for free cash flow, whilst decreasing, still around the 7% we want as a minimum, so we do quite like this, but you could argue something just to keep an eye on a quarter-by-quarter, year-on-year basis. Then we get to the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Below 4 is what we want for consumer staples. That is what we see. These numbers, effectively the number of years it would take the company to pay off all of their debt net of cash on hand. 2.66 in 2020 was the peak. It's been coming down since. 2.03 in fact in 2023, 1.83 over the next 1 month. So this is a good sign. It is moving in the right direction, and remember, this does correlate to balance sheet strength as well as dividend safety. Now, we also want to let you know we have released our latest free weekly article. We talk about 2 stocks we are buying this month, and as always, every Monday morning we do drop an article into your inbox. We talk about severely undervalued stocks that we do believe deserve your attention, as well as the market update over the last few days. So click on the pinned comment below, sign up, and you can read straight away. You'll also be able to gain access of 40 undervalued stocks for the month of November. Lots of information, upside that Wall Street themselves see as well over the next year. And you can grab a copy of 22 undervalued stocks that Wall Street themselves believe have the most upside in the S&P 500 over the next 12 months. So click below, sign up, and you can read straight away. We then move on to insider ownership at 0.14%, around 9.1 million worth of sales over the last 12 months. And when we look at the more recent quarter, we see no movement. Same to be said for Q3. So you have to go back to Q2 where we see 1 million worth of sales. Now, we would argue that is outdated, but you can see the information here. It was in fact on the 9th of May where the CEO did sell around 5,620 shares, netting him $1 million. Again, we believe outdated, not relevant, also not a bearish signal, but you can see this there for your own investment thesis. Institutional ownership was 73%, 17 billion worth of sales over the last 12 months. We're looking at less buys by institutions over the same time frame, but in Q3 we do notice a little bit more buying than selling. So overall, institutions are actually selling more of PepsiCo than they are buying, but we do notice more recent quarter a little bit more buying. As always, do your own due diligence and never copy what these insiders or institutions do. Now, we did say their top line struggled in terms of keeping up with inflation, around 40% increase over the longer term, 92 billion reported in December 2023. And when we get to their bottom line, which is ultimately what we want to show today, does it follow suit? We can see fairly inconsistent in reality. In fact, 2018 was the highest they have reported. Since then, it hasn't reached those highs. We're talking about 5 years later, but overall it has increased their bottom line around 40% as well. So you could argue, when zooming out, 40% increase to both their top line and their bottom line. Just be aware though, this isn't a typical growth company, so do understand what you own or what you are considering in the portfolio. In terms of total cash or cash versus debt for our health check, we notice very inconsistent. In fact, 8.8 billion in 2014, just under 8.1 billion in the latest quarter. So relatively little movement, but this information isn't going to tell us anything. So let's compare it to their total debt numerically and directionally, where we see actually their debt has been increasing over the longer term. 29 billion in 2014, 45 in the latest quarter. As we just saw though, their net debt to EBITDA does look to be okay for now and decreasing, but always good to have these just to flag in case they do get out of control over the next few quarters, over the next few years. Just something to be on your radar. Then we get to the valuation, where they are a D+. In fact, on a non-GAAP basis of around 20.21, they are trading above the sector median. We already discussed this at around 17.5. So if you're buying this company right now, you are paying a premium of around 15%, and that is reflected no matter which valuation metric you use. If you're buying PepsiCo today, you are paying a premium to the overall sector. Is it worth it? Maybe. Again, we will come to our conclusion when we do get to our valuation. In terms of growth, well, C-, not looking good if it is trading at a premium in terms of the sector. 0.33%, so pretty much flat year on year. Sector median, while very poor, still better at 2.22. Forward looking, 3.41, marginally better than the 3 from the sector median. But the one thing that does let it down is that EPS growth over the next 3 to 5 years, where we do see the sector median come in marginally higher at 7.3. We then finally get to profitability at A+, where they do look a lot stronger. 55% gross margin, 36% margin for the sector median. When we get to the bottom line, 10.2%, better than the sector at 4.5%, and cash from operations really standing out, A+, 12 billion versus the 831 million from the sector median. So quick recap, only Quant give this a buy, with Seeking Alpha and Wall Street giving this a hold. D+ on valuation, C- on growth, with an A+ on profitability. Now, before we jump into our valuation, let's compare it against others in the sector. We have Coca-Cola, Monster, Keurig, Dr. Pepper, as well as some other big ones. Total return, including dividends reinvested, over the last year, you would be up around 2%. But what we do notice, the overall sector hasn't performed that great. We have Monster down 1%, KDP up under 10%. So just bear that in mind. The sector has had some trouble over the last year. And when we expand it over the last 5 years, again, you could argue these aren't the greatest returns for the vast majority. And over the last 10 years, you could again pretty much come to the same conclusion, unless you would be happy with around a 100% return. Now, whether or not you believe these are strong numbers, in particular for PepsiCo, that is what we are looking at today. Remember that the past performance doesn't give us any indication about the future. And the other thing to consider is against the S&P. Now, over the last year, S&P has significantly outperformed. Over the last 5 years, again, the same result. And over the last 10, again, 191 versus 126. Just consider that if you are investing for the longer term, a low-cost ETF could be a better alternative, unless you think PepsiCo will, at these values, ultimately outperform the S&P. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are notified as they drop. Now our intrinsic value of $172 is just the average of these three models. So let's just go through them quickly. We have the multiples valuation, companies in a similar sector and size, average PE multiplied by the EPS of PEP to give us an overvaluation signal. Now it's not far off, so you could argue overvaluation / reasonable valuation. We then move on to the dividend discount model with 7.3% average growth. We've gone 5.25 to be a lot more cautious, lower than the more recent increase, lower than the average, still giving us a nice undervaluation signal. Then we get to the DCF model where we have the free cash flow year on year. We have the growth rate, average around 2%. Now we have lowered our target to around 9% from previous episodes around 10. We have seen the struggling environment from consumers, as well as the fact that PepsiCo are selling less in terms of volume. So there is a bit of a worry, although we are being more conservative than management. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we have our intrinsic value showing us another overvaluation signal. So intrinsic value 172, average of these three today, and as always you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for PepsiCo or any others. Now in terms of margin of safety, as always on this channel we use a 10% MOS and we execute if it meets our three golden criteria: wide moat, strong financial metrics, good forward looking data. Now if you believe that today you would have to wait for around $155. In terms of a 5% MOS is where we see PepsiCo right now, and typically this isn't where we would be looking to add a company of PepsiCo's stature at the 5% point. Now in terms of where this stands at 15%, we'll buy at 146 and at 20% around 138, but as we said in today's episode, 5% MOS with only Quant giving this a buy, Seeking Alpha and Wall Street giving this a hold, and Wall Street's forecasted price $184 with upside of 13%. As always though, do give us your thoughts in the comments below. Is this a buy, hold or sell? And if you enjoyed today's episode, value was provided, smash that like button. Don't forget to sign up to the free weekly newsletter below and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.